On today's Hot Sheet, I'm discussing the biggest challenges for buyers and sellers and builders in today's stock market, the collapse in land demand that's happening right now, and mortgage applications for the past week. Today is Wednesday, August 27, 2025. I am Byron Lazine, and the Hot Sheet starts now. Welcome into the Hot Sheet live from Naples, Florida. Let me know wherever you may be, where you're tuning into live this morning. We do the show every single Monday through Thursday when markets are open, 9:30 on the East, 6:30 on the West. Subscribe to the BAM YouTube channel so you don't miss any of our content, including this daily Hot Sheet show, which is the only 24-hour look back on the housing market for housing professionals. Okay, it's been a cruel summer, according to Realtor.com. I said beginning of August. Boy, I love when the summer starts winding down. I just absolutely love this time of year in particular. August is getting closer to the rearview mirror. We're back to serious times. September signals more seriousness in life. I like life to be a little bit serious. I don't like all fun and games. And the summer, as it drags on, it's like, hey, can we get away from the silly holiday mentality? This isn't Europe yet. Let's get as far away from that as we can. Realtor.com says it's not only been a silly summer, but it's been a cruel summer. Okay. Why the housing market in the U.S. is stuck. Obviously, it's been stuck for a number of years. It's a 3+ year real estate recession. We look at transactions. We look at rates. Yeah, prices have continued to move up in 3 years, but that's not the signifier of whether the market's doing good or not. Transactions in the basement. Rates are high to fight, obviously, inflation, which Jerome Powell thought was transitory in the beginning. Okay, so why is the housing market this summer still stuck when we've seen our highest level of inventory since pre-pandemic times? In fact, we've seen a big increase this year in inventory, and this increase in inventory was supposed to help get the market moving again. Well, it hasn't really happened quite that way. Okay, inventory, according to Realtor.com, has climbed for 21 straight months. Prices have stabilized. This is what buyers have been waiting for. A summer, a time period where prices won't keep going up month over month. In fact, as we looked at yesterday with the Case-Shiller data, there's metros where year over year prices are down. There's real-time data that we've looked at the last couple of weeks that suggests almost half of the markets are trending down on home prices. So this is what buyers have been waiting for, right? Not so fast. The market continues to be stuck primarily because there's not a lot of motivation from the list side. I've been saying this for years. Guys that think this market, the real estate market, it's going to crash now. They've been predicting this for 5 years straight. They've been wrong every time. It's going to crash. I'll just roll out the same tweets every single year. The market's going to crash. 40% of homeowners don't have a mortgage. There's a whole bunch of them that are just comfortable with where they're at. Okay? They're totally fine just holding on to the property. Just because they want to sell doesn't mean that I'm going to feel like there's I'm not backed into a wall here as the seller. I don't have to take a certain number. I can keep the house. I have a low mortgage rate. So it's not that big of a deal to me. Digging into the data here from Realtor.com. There's an affordability double whammy going on. The high prices and the higher rates, as mentioned before. This makes buyers unhappy. Buyers believe high prices, higher rates over time should create a market crash. We've only seen one of those in the last 60, 70 years. It was when we had a mortgage crisis. In the South and the West, you've seen markets soften. The national median list price hovering around the 440,000. That's list, according to Realtor.com. That's essentially unchanged since 22. Overall, since 2019, the all-in monthly cost 20% down, plus estimated tax insurance is over 1,200 higher. So you can see this in the bar graph, this frustration of the increase due to the interest rate change on buying a typical home. It costs more than $1,200 per month than in 2019. Okay. Now, you'll see a lot of people on the internet filling up Instagram and TikTok with their tears about this. And I get it. I want, and if you've been following the hot sheet for years, I want a scenario where homes are more affordable. We don't have a shortage of 7 million homes in this country. We have an affordability shortage. We don't have a shortage of homes right now in the Sun Belt states. We have a shortage in the Northeast and the Midwest. It's geographically driven, but national home builders don't want to build there. It's too highly regulated to build there. It's too expensive to build there, and it's very difficult to build an affordable home. You impact affordability the most one way, and that is through the rates. Lisa Chinati and I we kind of went back and forth on this on Knowledge Brokers podcast on Friday a little bit. Like, there is only one short-term 2026 solution to affordability. There's only one. It's the rates. If the rate, there's a lot of long-term discussions that people keep trying to weave in to solve for the transaction lockup that we're seeing right now. And there's really only one. And that's why you're seeing this, be a focal point have you ever before seen so much attention on the Fed from the White House? That's all they care about, because to unlock and have a boom year in 26, it's all about the rates. So short term, you got to focus on the rates if you're looking at affordability. Long term, boy, there's a lot in that bag to unpack. Okay. But short term, it's all about the rates. This affordability from 2019 to today, the only thing that's really changed, we've actually built more. We've built at a higher pace in those 5 years. So, we've added new inventory. The only thing that's really changed is the rates. Okay. On this affordability. So moving here to whether sellers are demotivated or in denial. Either way, sellers say, I'll just delist. I'll reassert my control. I own the house. I own the real estate. And if I own it sub 4% or I own it outright, I do not have a corner at my back. I have flexibility. I have options. I don't have to sell when I own the home on cheap money. It's just not a surprise to me, but it still continues to baffle me how many people don't get it. When you print 80% of the US dollar in a 4-year time period, nobody hammers this home. But when you do it, home prices don't drop down to nothing. Because I promise you, if they did, we'd be in a lot bigger trouble. The US dollar would be absolutely worthless. When you take 20 cents and turn it into a full dollar over a 4-year period, you better believe your most important assets, like a home, are going to skyrocket in price and stay up there. That is going to be the reality of now and into the future. Yes, there is, in the real moment, some downward pressure on home prices. Tampa, as an example, couple points off. And no question about that will persist throughout this year. You may see a flat year-over-year home price situation. What I'm talking about is these 20, 30% drops that people believe are coming. And sellers know, yeah, you can offer me 20% less, but that's never going to be the reality. I'll just keep the house. So while the balance of power has clearly shifted away from a pure seller's market, and we're getting closer, we saw the NAR data, we're getting closer to equilibrium nationally. Florida, Texas dealing with buyers markets in a lot of metro areas. The active inventory, new listings, time on market, and price cuts, they're all up. 25 is the least seller-friendly market since Realtor.com began tracking data back in 2016. Okay. That's an interesting number. Meanwhile, the national median list price remained essentially flat during since spring of 22. Okay. So here's your delistings that are happening. Delistings per 100 new listings. And you got Miami, Orlando, Tampa, Phoenix. These are high inventory, and sellers just saying, you know what? I'll wait. I'm good. I'll wait for existing home sales to get out of the 4 million range and get back up to 5 million and then come back on the market. Okay. All right. Moving into some more. Here's the other reality with the builders. Talk about this a lot. Talked about it yesterday. Builders are pumping the brakes. They're unhappy with so everybody's unhappy. Okay. Builders, sellers, hey, I'm unhappy with what I'm seeing in the market. I'll delist. Buyers, prices aren't down far enough. And builders. Okay. Single family home starts are down as construction stalls. New homes for sale are up, but not yet started. New homes for sale under construction, down since the peak in 22. All right. So listen, there's only one short-term solution to make builders happy, sellers happy, and buyers happy. And it's the rates. Like, not a political statement, but the White House gets it. The pressure that is being put on the Fed right now on the rates is all because you can solve for three categories in the housing market: the buyers, the sellers, and the builders. If rates move down with a true 5 handle, somewhere in the 5 sustainably, things open up. More sellers say, I'll enter the market, become a buyer. Gives confidence to more sellers to enter the market. Buyers have a herd mentality. I keep saying buyers should be shopping now. Kind of like early lockdown days. Those buyers got incredible deals. The ones that weren't afraid of throwing a mask on and looking at a house, they got great deals. The early lockdown buyers. And the ones that waited till everybody was out there shopping, they bought in a very competitive situation. They got the good rate. So, I mean, they're doing good there. But the ones that got both, the good rate and the great deal, they were early movers. Buyers right now, they're smart to be negotiating out there right now. It's just quiet. It's a cruel summer, as Realtor.com says. It's a little bit quieter. Okay. I don't mind going to, I like, people say, Byron, you act like you're 80 years old down there living in South Florida and going to dinner at 5 o'clock. I don't mind a 5 o'clock dinner. I like it when nobody's in the restaurant. If everybody's there, it may feel a little more energetic, but I promise you, I get a lot better service at 5 o'clock. And by the time 7 o'clock rolls around and everybody's there and the energy's flowing, I've already got a great relationship with the staff. I've got everything I want, the experience that I want. And I've got the probably perfect seat because I had the pick of the litter when I got there. It's a good thing to be early. I'd rather be early than be the guy that's closing the bar at 12:30 and the staff saying, can we get this guy out of here? We want to go home. Who's the weirdo who's out after midnight? Get him out of here. I'd rather be early. And buyers that are early to the party right now, they're winning. There's a tale of two housing markets, though, of course, for buyers. If you're in the Sun Belt states, If you're in the West, you've got the opportunity to have more leverage being early. But knowing what's going on in the Northeast, Midwest, there's not a fix for 2026 when it comes to inventory. So if inventory has yet to recover, there's not a sign that it's going to, and then rates come down, what buy side market do you want to negotiate in? Now where things are just a little bit quieter, where you can at least get a seat, you can get a home tour, you can get your offer in. Or do you want to do it in a market that looked like 21 and maybe spring of 26 looks more like 21 than it did 25? I think I'd rather be getting to I like getting to restaurants early. I like having great service. I like, being heard. Buyers should want to be heard. You're going to have a better chance of being heard right now in this market than when rates go down. I know it's kind of like, it's like a Jerome Powell situation. Well, if I wait for rates to go down, I get the better rate. If I can negotiate now, I get the better deal. It's like Powell. Oh, if I cut rates now, I'm going to help the job market. If I don't cut rates now, I'm definitely going to kill inflation. I might even put us into stagflation. By the way, Jerome Powell now, if you missed it, Monday, admitting, tariffs are a one-time price impact, if any, not a tariff, tariffs are a one price impact, not an inflation infuser like he's been warning against. Haven't seen that. It's been quite some time. The South and West soften, Northeast, Midwest remain tight. That remains to be the scene there. So here's the thing. Talk about stagflation. I don't want to talk about it, but if Powell doesn't start making some moves here soon, we will be talking about it. But in real estate, we're talking about stagnation. Okay, so not crisis, but just stagnation. And not a lot of movement. Okay. I like a lake more than a small little pond. I mean, a small little pond that's, maybe got 3-4 homes on it. It's got no water flow, no natural water flow. It can get stagnant, can get a little mucky. I prefer a bigger lake where the water's moving and you're like, whoa. I remember I was with somebody in Chicago years ago. One time we're driving by the Great Lake there, and he says, what ocean is that? I was like, dude, I mean, I knew you weren't the smartest, but come on now, bro. I know there's waves there, but come on. The cruel summer of 25 is defined by frustration and hesitation. Unhappy buyers, sellers, and builders. They're all pulling back. Okay. Regional dynamics are pulling places further apart. What ties these frustrations together and what sustains the market and the expectations reality, or the mismatch between, I think what ties it all together here is one thing. It's moving those rates down, getting the rates with a 5 handle, and we'll see this kind of story flip. All right. What is flipped in the market is land prices. They're set to decline according to John Burns Research and Consulting. Land market is cooling fast. Have you ever met a land owner and they want to sell and they're like, I've been sitting on the land for 20 years. A lot of landowners, they just hold land and they love paying taxes on land because they think someday they're either going to find gold under it or somebody's going to offer them, a Powerball winning scenario for this land. And it's like, dude, you decided to sell it when building is extremely high and builders don't want to build. Like, the builders that are building need to have a discount somewhere. They're not getting it, from rates. So they got to get it from the land. So if you want to sell your land, materials aren't coming down. Rates are what they are. If you want to sell your land, that's where the discount comes. Okay. A builder can't say, I'm going to do a high rate environment. I'm going to pay extremely high labor and material costs and high land costs. Well, that's a recipe for going bankrupt, disaster. So land market's cooling fast right now because of this dynamic. After 2 years of fierce competition with land, demand has collapsed by nearly 2/3. Okay. That's the other thing. Buyers like, I don't want to sit on the land and pay the taxes. Only 28% of land brokers report strong demand in their markets. A year ago, this number was 76. Okay. In 22, when rates popped, when Powell figured out, oh, these aren't transitory, this is what happens when you print all this money, and rates popped, this happened as well. Okay. So top land brokers are ranking the market hotness. And you got 2% in quarter two of 25, 2% of markets that land brokers would consider on fire. Only 2% of markets right now. That number in quarter two of 21 was 59%. So a huge swing of what brokers would say, yeah, we're on fire with land demand. You've got 26% of markets right now that are hot. So 28% that are hot or on fire. Still 41% that are warm. And then you've got your lukewarm and cold markets. So what land brokers would consider cold, not a huge number. That was a bigger number in 2022. I think the number grows as we go throughout the year, unless rates come down in the short term. But if we're going to hang at 6.5 for the rest of the year, then I would imagine that cold segment, according to John Burns in consulting, is going to grow. Here's the market dynamics explained for land. Okay. New home prices fall, builders margins shrink. Then builders realign. They cut specs, slow starts. They walking land from deals not closed, walking away from land deal. Oh, we had a deal, now we don't. Renegotiating terms with land sellers. Then comes price discovery for new land deals. Requires costly incentives for home buyers, but won't pencil for builders at legacy lot prices. Then builders increasingly walk from deposits. You know what? I'll actually lose more. I'll lose less if I just leave the deposit. And then longer term entitlement regains interest as builders shun finished job lots delivering near term during market downturn. That's the market dynamics. That's the cycle that happens right now when interest rates continue to suffocate building as it is right now in builders. Okay. National year-over-year price change, finished lot prices versus new home prices. Right now we're seeing obviously new home prices net of incentives continue to move down. That number is actually new home prices net of incentives is down -1%. Okay. So there you go. We're continuing to see builders in a really tough spot. How long can they maintain that? Remains to be seen. Remember, or maybe we didn't talk about this, but I'll bring it up now. I don't know if we mentioned this last week or not. The belief is that the future is going to be bright. Okay. If you look at one of the indicators that I would suggest for obviously everything that we talk about, but one of those indicators right now is the fact that this year, planning maybe for 2026, does that future look bright enough where we're going to get these low rates? You know, one of the smartest men in America investing, Warren Buffett, remember a couple of years ago when the rates shot up, he pulled out of national home builders. What'd he do at the start of 25? He plowed back in with $1 billion on home builders, Lennar, D.R. Horton. So there's a belief, okay, things are going to get better. He likes to move early, get obviously those gains. And these national home builders have moved up here this year. Well, they're not doing good right now. So is this maybe one of those you can kind of pencil away as a probably going to see rates down in 26 as we're starting to see some momentum head in that direction? I would imagine that Warren Buffett believes that to put $1 billion in national home builders. Mortgage applications for the week decreased 0.5%, according to Mortgage Banker Association. This is on the headline number, which includes refinance. Okay, so what do we care about? We primarily care about here the purchase index. Purchase index increased 2% from 1 week earlier. So another week over week increase on purchases. And what do you know, year over year, another double-digit gain, 25% higher than the same week a year ago. Mortgage rates inched higher last week based off of that year-to-date low. Now, we have seen interest rates this week get back to year-to-date low level. In fact, yesterday, we matched the year-to-date low of 6.52, which was set on Friday. Monday coming in at 6.54. So we should see a week of data next week where we're at year-to-date low, and we'll see where the applications obviously come in then. But right now, sitting at 6.52, matching a year-to-date low, and the 10-year right now starting the day at 4.277. That number is on the low side for the last 5 days. All right. There's your hot sheet here for today. We'll be back here tomorrow, 9:30 on the East, 6:30 on the West. Hope to see you guys in BAMX. You get all access to all the slides in BAMX from the hot sheet each and every single day. School.com/BAMX. I'll see you in there. If you remember, it's the best way to DM me and get a hold of me. School.com/BAMX. And I will see you guys back here tomorrow. Until then, toodaloo.